Welcome to Mangata Monday. Today we talk about DEX Basics. We will be talking about automated market makers, liquidity pools, and impermanent loss. And with me today I have Martina Panini. Hi Martina.
Hi Tommy. Hi everyone.
You just joined our team, I think it was 2 weeks ago, right?
Yeah, actually this is my fourth week, if I'm not mistaken.
Yes, okay, the 4th week. And so you are manager operations. Martina, what does a manager operations do?
So this is a new role within the Mangata team. So at the moment, I'm actually absorbing all the information from all the team members, what they are doing, and main contribution for the moment is to help them with the project management and all the phases and timing. So we will see how it develops later.
Yeah, so we are having a lot of calls, and basically you are asking everyone what they are doing and how everything works together. And I guess you're looking at where is there inefficiencies, how could we do the planning better, and so on, right?
Exactly, yeah.
Right. But what is more important for our session today, you are also a crypto newbie, right?
Exactly.
So what does it mean? You when did you first hear about crypto? What did you know up until 4 weeks ago?
So, of course, I did monitor crypto and blockchains and all this information as I already worked in the development area, but I never worked directly in this environment. And I never actually did anything like following all this situation and doing something myself, like trying to invest or play with it a little bit. So I have no practice. I have some theoretical knowledge, which is really basic, and that's it.
So if I would ask you how Bitcoin works, could you tell me how a block is created?
Okay, so probably would go back to mining, and when it was like a few years ago, this rush about mining and everything. So that would be what I would be probably mentioning to you. But like the whole mechanism, I know that there are some nodes or mining which creates some algorithm. But I wouldn't be able to go into very specific details.
Okay, so I guess you're the perfect guest for today because you will be the testing ground where I will try to explain how decentralized trading works and how automated market makers work. And you will tell me what you do understand and what you don't understand, right?
Sure, I'm actually very happy about this session because it's really super useful for me also.
Yeah, so we actually were seeing some questions. I guess since Mangata X is branded as being for experienced traders and experimental tokens, I guess we have a lot of experienced people. But on the other hand, it's a topic that is very young, so it isn't taught in schools. I guess most people were exposed to it less than 2 years ago. And so it's a new topic for everyone, and there's constantly to learn something. Okay, so I have prepared a presentation. And maybe let's just start into it, and then we will see how this works. And I prepared a link for everyone looking at the Mangata Monday chat about our recent blog post, if you are interested in that. Okay, so the agenda for today is I will be talking a little bit about the order book model, about automated market makers, about liquidity pools, and impermanent loss. So quite a few new terms. You don't need to capture all of them. I think it's important to capture the concepts, and the concepts are, let's say, medium. Yeah, they are not too easy, but they are also not ultra hard. They are not ultra hard, and you can see that from the fact that a lot of people are talking about it. Yeah, and so it's not as hard as like the theory of relativity or something like that. Okay, so and to understand how DeFi, how decentralized exchanges work, we will be starting with the order book model. And the order book model is what you see in traditional markets. So for example, you have an exchange like the New York Stock Exchange or any other exchange, and you can buy and sell, for example, stock there. So you can sell, let's say, a Tesla stock, or so. And that means there is a market for Tesla, for example, against the US dollar. And so I don't know what a Tesla stock is priced at the moment. I'm sorry. Let's say something. Let's say it's $100, and so you pay $100 and you receive one Tesla stock. And so this is then the price. And how this works in traditional markets is that there you can imagine 100 years ago they didn't have computers and so on, so they had a book, and everyone who wanted to buy or to sell wrote it into a book, let's say, and so this was called the order book. And the order book kept all the orders when someone is offering or trading a number of stocks for buying or selling. And so this is how the model developed, even into modern markets today. So there are a list of trades that are being offered, and the trades are expressed in, for example, you say one Bitcoin is worth $40,000. So, yeah, and so you have a full list of this. So, for example, one person is offering it for $40,000. One person is offering it for $39,000. One person is offering it for $41,000. And so you have a lot of different traders offering to buy and sell that Bitcoin. Does it make sense so far?
Yes.
Okay. I tried to pull out an example so that it makes a little bit more sense. Do I have it here? Okay. So I put in this tab here as an example, and this is how traders, so this is Binance. It's a very big decentralized exchange, but it follows the order book model. And so what you see is you see the price chart here. This is what a lot of people look at. And then there is something that not everyone is looking at. Here you see it on the left side, and I tried to make it a little bit bigger here. So what you see is all the different offers for different prices. So for example, here are people offering to buy Kusama for Bitcoin. And so they are saying, I offer 0.0038 Bitcoin for one Kusama. And so you see the prices are getting cheaper. So more people try to pay less to get one Kusama. And you see more and more people here going down. And on the other side here on the top of the order book, you see that people are offering to sell one Kusama for Bitcoin. So they want to have more Bitcoin for one Kusama. They are trying to sell it at a higher price. And so you're seeing those two sides of the order book. And in the center, you see the latest price that was traded. And so a lot of these entries are always going into the order book, going in and out. And this is the, let's say, the fight between those two sides, the buy side and the sell side, and those are determining the price. Okay? Okay, so this is the traditional model. This is the order book model. And I guess there have been written a lot of books on this. And we are now introducing a few concepts, and you will see in the presentation they are always marked in bold. So trades are offered by market makers. And we have this pair of makers and takers. There are market makers, they are offering trades, and then there are takers that take the trade. So a market maker will set an order. For example, I will buy one Bitcoin for $40,000. And the taker takes that offer. He says, yeah, okay, I give you one Bitcoin and you give me the $40,000 that you offer. Yeah. And so the term we are using here is limit order. And on the other side, there is a market buying. So some people are setting limit orders. They are putting the trade on the market, and they don't know if it will be taken or if the market will move in another direction. But the takers always take an offer that already exists on the market, makers and takers. Usually, makers are considered to be big entities that can make the market. They can offer the prices, and the takers have to take whatever there is offered. Okay, so makers and takers. And now we offer a new word. So this works in market with deep liquidity, where market makers offer a lot of trades. Now the question is, what does liquidity mean? Martina, do you have a conception of the term liquidity?
It would be great if you elaborate on that.
Okay, yeah. So I've written it down like this. Liquidity is a term that is used to describe how easily money can move. So it is a somewhat of an abstract term. It's not something that you can touch, but yeah. On the other hand, it's still easily understandable. So let's take one market, for example, that is highly liquid, the most liquid market in the world, and that is the euro-dollar market. So there is just a lot of euros and dollars being offered for trade against the other. For example, you can go to any exchange in the street and exchange euros for dollars. Or a lot of exchanges in the world where you can do it on the street. And there are very big foreign exchange markets where euros and dollars are traded. So this is considered to be the most liquid market in the world. Just because there is so much being offered, there is always an offer that someone can take. And it's therefore considered to be deep, highly liquid, or it has deep liquidity. And it's even better understandable if you compare it with the opposite example. So let's say, what is the market to trade sheeps against Lego pieces? Yeah? And I guess you will have a very hard time to find someone who offers you to give you a sheep when you come with your Lego pieces to buy a sheep, right? So this is, I think it makes it much more understandable. This is an illiquid market. So there are not really any market makers for sheeps versus Lego, but there are a lot of market makers for euros versus dollar. So the opposite here is shallow liquidity, or sometimes you talk about the thin market. Yes, and so going back to the previous page, the classic order book model works especially well when you have deep liquidity, when there are a lot of trades being offered, because this always makes sure that there is something in the order book that someone can take. But now, on decentralized exchanges, we are having two problems. The first problem is a technical problem. So you especially see this on Ethereum, for example. Market buying with an order book model is gas expensive because it's a technical reason. Market buying requires that if you say I want to buy for the best price on the market, the program, the smart contract has to go through the full order book and check against every order. And usually gas is something that is expensive, and so gas is the term that says how complex is the computation for the computer. And the more complex the computation is on a blockchain, the more expensive it is, because that's the service that a blockchain offers. It offers a smart contract blockchain like Ethereum or Moonriver or so. They offer computation, and that is the price you pay, gas. So market buying is gas expensive. We have to accept it because it has to compare a lot of data, and that just takes time and processing power. That's the first problem. The second, and it makes trading expensive and unattractive. The second problem is that a lot of pairs have shallow liquidity. So similar to my sheep versus Legos example, there is a token that's called Ape and there is a token that's called Doge. But you can expect that there are a lot more traders for Bitcoin versus Ethereum than there are traders for Ape versus Doge. So the Ape versus Doge market is just much more shallow. You have few market makers who are even interested in offering to trade those tokens against each other. And so this becomes even more a problem when you have the same tokens being offered in a lot of different exchanges and you have fragmented liquidity. So the same liquidity is split up between more exchanges. And so these two problems, that market buying is gas expensive and you have shallow liquidity, has led, it was a real problem. And so it has led to an innovation Oh, I have written down a little bit more. Yeah, what if there are just a few market makers offering trades? It can, oh yeah, and it can result in highly manipulated markets. And so the price discovery can be manipulated. You don't really know what's happening there. Yeah, so it can jump a lot. And so the solution, the twist in the story here, are automated market makers. So we've just heard the term market makers. It's those that offer something for trading on the market. And so this is the twist. Automated market makers, AMMs, offer a solution. So they are a mechanism to make sure that there always is an offer. It's a machine that makes sure there's always an offer. It's a market participant that runs as a smart contract, usually, or another type of program on the blockchain. And the way that it does that is that it always holds both tokens. So for example, it holds 100 Bitcoin and $4 million. And the holding of those two tokens, they are held in a liquidity pool. And you can consider the ratio of both as the price, roughly. So if you divide $4 million through 100 Bitcoin, you get a ratio of 1 Bitcoin is worth $40,000, which it is today. And so what an AMM does, it offers a trade into both directions. Does it make sense so far?
Thank you.
All right. Okay, I'm always monitoring Mangata Monday too. Okay. So yeah, you can, an AMM that is offering trades in both directions means you can buy 1 Bitcoin for $40,000 and you can sell 1 Bitcoin for $40,000. So we just mentioned the liquidity pools, and so let's go a little bit into that. Liquidity pools are this thing in the automated market maker that allow assets to be exchanged. And it is a mechanism that allows several liquidity providers to pool liquidity together. So now we are having the term liquidity provider, and this can refer to an actual person or company or other entity that is providing liquidity to the market. So we are referring to liquidity providers as LPs. And these are the market participants that offer the capital in the form of the two assets. So in a sense, the liquidity providers are the actual market makers, but they're handing over their assets to the automated market maker and tell the automated market maker to take care of it and to make sure that the market stays liquid and that there is always an offer. So liquidity providers hand over the capital. They have to understand the rules and how the system works, but then they can lean back and let the automated market maker do the work. And so they give up their token ownership. This is important to understand. They give up the token ownership in exchange for LP tokens, which is also a term that is usually used. And those LP tokens represent a share of the pool. Let's do an example. So let's say you have a liquidity pool of 90 Bitcoin and $3.6 million. And so Alice adds 10 Bitcoin and $400,000. You see that we're still keeping our ratio of 1 to 40,000. So the pool now has 100 Bitcoins and $4 million. And so what Alice has in this example are LP tokens that represent the worth of 10% of the pool. So there is a capital of 100 Bitcoin and $4 million in the pool, and she holds 10% of that pool. Why is that important to know? This is important to know because that ratio can change when there's actual trading going on in the pool. So liquidity pools until now, I guess with the example they make sense. Or is there any questions so far, Martina?
From my side, not for the moment. I'm just curious about the next part.
Okay. So we move on to trading. Okay. AMMs and how trading works. So you can look at the ratio that we just had, and you can say the current ratio of the pool is roughly the price. So in our example, we say the pool has 100 Bitcoin and $4 million. And so the ratio is 1 Bitcoin to $40,000. And that means the price of 1 Bitcoin is roughly $40,000. And I'm saying roughly because now it gets funny. So the trading is dependent on a formula, and this is called the invariant. So up until now, I think it has been fairly easy. This gets a little bit more complex, but don't let yourself be frightened by the term that you usually don't hear. This is just a math term. I have prepared 2 graphics that make it a little bit more understandable. And to understand it, let's say you maybe I should even take a step back and explain something here. Okay, let's say, okay, what did we have? I have 100 Bitcoin, and then here we have 4 million USD. So that's our example that we're going with. Okay, and now let's say what would happen in if you have a rough and easy understanding. I move this up a little bit. Let's say you want to exchange, and so what do you know about the ratio, Martina? What is the price ratio?
So 1 Bitcoin is 40,000 USD.
Yeah. Okay. So now let's say you want to, let's say you have if you have $2 million, how many Bitcoin do you get? It's not a trick question.
I just need to divide it.
Yeah, so I guess the example would be that you say I pay $2 million, so I would get 50 Bitcoin, right? Mm. Okay, so now $6 million are in the pool here. I added $2 million and I took out 50 Bitcoin, right? Okay, now if we look at the ratio, what is the new ratio? It has changed. It has changed. I see. Okay, yeah, so the thing is now the ratio has changed and the new ratio that you're having is different. So if you divide the two, you would now say that, let's get the calculator because we're lazy. So you have 6 million divided by 50 Bitcoin, and you now have a price of $120,000. Woo, $120,000 per Bitcoin. Extreme, huh? So what we are seeing here is that the ratio can change over time. And so this represents a problem because this means maybe you shouldn't have gotten the 50,000 Bitcoin, the 50 Bitcoin here for $2 million, because now the price is 120,000. So you actually got a pretty cheap offer here. So this is a problem, and this is now where the math people come in and they try to solve this. And the thing we just did was basically that we used a constant sum function. So let's say you are here in the liquidity pool, somewhere here. Let me draw an arrow. Let's say you're here in the liquidity pool. Now, if you say I add some USD, so you go on the x-axis, on the x-axis here, and you increase the amount on the x-axis, then you have to decrease the amount on the y-axis, and so you would land somewhere here, right?
Yep.
So this is the moment where I said it gets a little bit complex, but we try to visualize this by adding those graphics. And so the thing is, it gets complex here, because let's say we want to maintain that ratio. So we say we don't want to pay the new ratio, but we want to pay the old ratio. What it means that you can pay maybe $2 million more, and then you drain the last Bitcoin out of the pool. But that would defy the initial idea of the automated market maker, that it always can offer tokens. So you could either say the price stays the same, then at some point the pool gets empty. You could say the price stays the same, then at one point the pool gets empty. This is this model. At some point you reach the end here. At some point you reach the end here, and then you have 0 Bitcoin in the pool. All the Bitcoin is bought. But that defies the purpose, because then the market maker can no longer offer a trade. And so what the math people come up with is that they say, let's make it a curve. Let's say that the price changes over time, and for paying more dollars, you get less Bitcoin. Or in the other direction, at some point, if you pay more Bitcoin, you just get less and less dollars. Okay, so this is the visual representation of the solution that I tried to present here with the ratio. So the ratio changed. The ratio changed. And if you have a different ratio, you can say that the price can change over time. Does it roughly make sense?
Yes.
Yes. Okay, I'm glad. And the funny thing is, so Nick was just writing in chat. I'll show this here. Nick was just writing in chat. It's an integral. So that's right. That's why I was saying the math guys, the math people are coming in. So the way that it is solved is with a little bit of higher math, and it's with an integral, and it's with funny formulas where you can read a lot of papers on it, which I sometimes do in my free time. But I won't bother you with it today. I think the important thing here is to look at the curve and to understand that curve. So to understand that the market maker will always try to make an offer, so it will never reach a point where it is 0. And that just means that the price slips. So in one moment the price can be $40,000. And if a lot of tokens are transacted in one way, the price could change to $120,000, which is a good thing, because actually on the market the price needs to change, and the price needs to adapt to whatever there is on supply and demand, right? Okay. Yeah.
I have one question.
Yeah.
We are not going to explore this topic, but is this related to this concept of impermanent loss?
It is related to impermanent loss. Maybe we should even pull it up. Maybe we even have some time to look into impermanent loss, but I just struck it from the agenda today because I wanted to take the time to discuss this. But maybe we have the time. But maybe let me finish that point, and then we see if we have the time to look into impermanent loss, okay? Okay. So, okay, so what we have here is that I can tell you the most common automated market maker is called a constant product market maker. And sometimes it's called the XYK variant. Sometimes you just see people write on Twitter XYK. So, and why is that? That is because they are saying, so X, the amount of X tokens in the pool and the amount of Y tokens in the amount of pool should equal a constant that is called K. So, and that is just a math formula for this curve. That is just a math formula for this curve. If you have X amount of tokens and you have K given, then you always know what Y is going to be. And so, yes, on one side it's an integral, but on the other side you just need a multiplication to solve it, which we are happy about. So, but if you use that formula, if you use XYK, you get this curve. And then on the other hand, if you use X plus Y is K, which is called the constant sum market maker, you get this thing here. Okay. Okay, and so 2 points that I can offer here is that the constant product market maker always has tokens to offer in both directions. But the price just gets more and more expensive the further you go down the curve. The further you go down the curve, the more extreme this gets. And this is called slippage. And last week, one of our meme lords created an appropriate meme for that. So I compared liquidity pools to actual swimming pools. And that was when I was giving the example for our liquidity bootstrapping event. So why do we have a liquidity bootstrapping event? It is because the lower the liquidity is here, the higher the slippage is. And we could even have an example for that. Yeah, let's have that example. So let's take the example here that we have. And we played this example here with the example of $2 million. So if we are transacting $2 million, this is the example and how it is valid. But now we're going to change the example a little bit. So let's say we are not having 100 Bitcoin, but let's say we have 100,000 Bitcoin. And we are also go times 10 here. So in this pool here, we have also 1,000 times the amount. So we have $4 billion. Okay. So what would you say about that pool, Martina? How could you compare those two pools?
It looks like the ratio should be the same, right?
Yeah, that's right. The ratio is the same. That's a very good observation. And we can have a second observation, because maybe in reality, because the other pool is 1,000 times that much, actually you could say, if you remove the font here, actually this pool is like this big. Mm. Maybe we make the font also 2,000 times smaller. So this pool is so small and these pools are 100 times bigger. And I will show you what that means. And I give you a spoiler. We're calling it... No, I'm not giving you a spoiler. Okay, let's say you are transacting $2 million again. Okay, so you come, you say, I'm in a good mood today. I want to spend $2 million. What should I buy? Let's buy Bitcoin. So you add $2 million to the pool here. And you buy 50 Bitcoin. So what do you get? 99.9. So that's what you get, right? You put in $2 million in the pool and you got 50 Bitcoin out of the pool, right? Okay, so there is a difference now, and I have to make some space here. There is a difference now. This also goes away. This is why you make when you make it a talk, but at least it's a little bit more interesting. Okay. So if you calculate the new ratio here, if we calculate the new ratio here, we say $4 billion $2 million divided by 99,950 Bitcoin. And you see that the ratio is 1 Bitcoin is $40,040. So you have the same example. You have the one liquidity pool here which is 1,000 times smaller, and the price changed to $120,000. And here the pool is 1,000 times bigger, and the price changed not so much. It just changed $40. And so this is the result of deep liquidity. This is the result of deep liquidity. So this pool is 1,000 times more liquid than this pool. It's 1,000 times deeper. And the result is that the price doesn't slip so much. So you have less slippage. So this is why you have all the crypto nerds and all the DeFi nerds always going hype about deep liquidity. That's why people like us like to talk so much about deep liquidity, because let's say you have an investor coming in and they are having even a better day than you, Martina. They don't want to spend $2 million, but they want to spend $200 million, and they want to buy Bitcoin. Okay, they're even going to have a difficult time with this pool, but you see the difference. If they would spend their money in the small pool, they would have a lot of slippage. So it would take a lot of time for them to do their trades. Versus if they go for a pool that has very deep liquidity, they have a better time because they can exchange more money for money. So they can exchange their tokens in an easier way. So that is why we call, why we care about deep liquidity. And that's why we care about low slippage. So this leads us back to that meme, which I guess makes sense now, because if you have low liquidity, you have high slippage. And it relates very much here because it just keeps you, it hurts you. And so this is the main reason why we are having the liquidity bootstrapping event. We are taking time in which trading in the pool is not allowed, and we allow the pool to fill up during that time. And only when the pool has filled up to have sufficient liquidity is trading enabled. And this makes sure that traders do not slip, they do not lose money by accident because the slippage is so high. Punkt. So now I'm going to look at the chat. Okay. Okay, I guess we're having Nick to Nick as a person who is more of an expert on it than I am. So maybe Nick to Nick, maybe one day you want to join us in the call, or want to co-host the call. Maybe let me show it for the recording here. So they had a short discussion. Nick to Nick was explaining what impermanent loss is and what happens here, and then suddenly Greek letters are getting thrown around. So this is how fast it can escalate when you start talking about it in crypto. Okay, so in theory, we would even have a few more minutes to talk about impermanent loss here, or you are having more questions, Martina?
Actually, I'm quite, I don't know about others, if they have some other questions. I really like how you explained the book order and the concept of market makers and takers, and how you connected it to liquidity providers. They are actually makers, and actually letting the automated maker tool, or AMM, I don't remember the abbreviation, to make this process automated. It made a lot of sense to me. So for myself, I would be good to even learn more about this impermanent loss. I'm quite curious about it because I just read something very quickly yesterday. Let others see also.
All right. Okay, then let's go into impermanent loss. Okay, let's start with an example. So Martina has $2 million to spare. She buys 50 Bitcoin. Okay, So far we have that established. Okay, so you are holding 50 Bitcoins. And now, let's say 4 years pass. The Bitcoin are now worth they were now worth 20 million USD. Okay, typical crypto example, right? You buy Bitcoin, you wait for a decently long amount of time, and up until now in history it has always shown that if you wait 4 years or more, you are positive on a certain amount. In the past, it always was a big amount of multiple. In the future, it will get less and less because the market has just grown so much and is saturating so that there are not that much gains. But if you wait decently a long amount of time, you are gaining. Okay. So this is a nice example for you. And now the thing that a lot of people are scared about when providing liquidity, so we're calling this the HODL example. And so HODL is crypto. You might know it already, but HODL is crypto speak for you hold it. The backstory is that a drunk person was posting it in the forums that they are hodling, and it just caught on. Okay, so this is the HODL example, and now we are going into the LP example. Martina has 2 million USD to spare. She buys 25 Bitcoin. She buys 25 Bitcoin and keeps 1 million USD. So she buys 25 Bitcoin for 1 million USD and keeps 1 million USD. Makes sense so far, right?
Yep.
Okay. I think I'm creating a new slide here because we will need some space here. Okay. So, and what she does now is she buys LP LP tokens. So she provides liquidity for 1 million USD and 25 Bitcoin. Okay. 4 years pass. And now let's see how her portfolio developed. So in the previous example, Bitcoin was worth 10 times the amount. So Bitcoin goes 10x. Okay, that was the previous example. In this example, it's the same. So Bitcoin goes 10x. Okay, what is your liquidity worth now? And this is where the curve example now comes in, because if we go and look back at the curve, so we borrow this slide. So what you see is that initially maybe you bought Bitcoin here. And now over time, a lot more dollars have gotten into the pool and a lot more Bitcoin has gotten out. So 1 Bitcoin is worth much more in the pool. So over time, you progress to this point. And that means more dollars have entered the pool and more Bitcoin have left the pool. And so if you are holding liquidity, you are holding a percentage of the pool, and the pool now has more dollars and less Bitcoin. So it has maybe roughly 10 times more dollars, or in other terms, 10 times less Bitcoin. So what would happen? We could, now if I had more drawings, it would be better, but Martina liquidates her LP position. She gets, I guess Nick knows the exact answer now, but what she gets, let me do some meditative exercise here while I contemplate the result. It would be something like, so her position should be now worth roughly maybe $5 million or something. Yeah, I give a rough example. It's just very rough. But so it didn't 10x, but it 5x roughly. So it should be, let's say, 5 million USD or something like that. Let's say 4 million USD and wow. So wait, so two went to $10 million, so that's $5 million and maybe 2.5 Bitcoin, 400,000. Yeah, that's the same, but it's more like 1 point something. It's let's pretend it's something like this. But the thing is, if you hold a liquidity position, you're holding both assets. And so you're not just holding Bitcoin, but you're holding Bitcoin and dollars. And so Bitcoin will go up in price, but dollar stays the same over the 4 years. And so what that means is that you only invested half of your dollars in Bitcoin. They went up in price, but the dollar stayed the same. And so when you're buying liquidity, it's a little bit like you're buying the average of both tokens. And so what you're having is, and maybe this is more specific, Martina's position is worth roughly 10 million USD. So if you compare the two examples, in this example, your position, if you just held it, your position would be worth $20 million. But when you bought liquidity, your position is now worth $10 million. So this is called impermanent loss because you're holding the liquidity and the ratio changed. But if you just held the single assets, you would have profited even more. Does it roughly make sense?
Yes. Yeah.
Okay. This is a thing which you usually can look up multiple times and it will click over time a little bit more and more and more. But the general idea is that usually providing liquidity is best if the ratio does not change. So impermanent loss only happens when the ratio changes. So for example, holding dollar versus crypto, because crypto always changes the price and dollar always is the unit that is being calculated against. So dollar and crypto always change the relationship to each other. There are assets which are not changing the price to each other. So maybe let's write this down. So impermanent loss happens when the ratio changes. So for uncorrelated assets, assets that are correlated do not experience impermanent loss. So for example, these are sometimes called stable liquidity pools. So there are different crypto assets that represent $1. So for example, USDC, USDT, sometimes you call Frag style, and then there is KUSD in our space AUSD. So these are all represent $1. And so if you pair them against each other, for example, USDC, USDT is very common. Both represent $1, so they are correlated. So they experience no impermanent loss. Assets that are correlated experience no impermanent loss. So is it bad to provide liquidity then if you are losing? It depends. So there is another side of the coin. So while you are having impermanent loss here, where in the impermanent loss example, where you are only gaining 50%, you are only gaining 50% if crypto goes up. The opposite is also true. So if crypto goes down, you only lose 50%. So impermanent loss can work as a risk mitigation for some. They can decide to provide liquidity of dollar versus crypto because they say if a crypto goes down, it only goes down 50%. So maybe to conclude this a little bit, when does liquidity provision work best? When assets are highly correlated. And now there is one important thing that we forgot, and that is when volume is high. Why is that? Why is that? Because LPs are getting fees for transactions happening in the pool. We maybe should have mentioned this in the very beginning. This is the reason why you're providing liquidity, is because you're getting fees. So liquidity providers get fees for providing liquidity. And this is some percentage of the volume. So when the volume is high and the tokens are correlated, this is the best asset to provide liquidity against. But this is not always the case. And so traditionally, people were reluctant to provide liquidity. People were reluctant to provide liquidity just because of those facts, because it's not easy to provision liquidity when you can just hold Bitcoin or whatever and get rich by that. So how did this change? How did this change? And this changed with the DeFi summer of 2020. So it's not the summer of 69, it's the DeFi summer of 2020. And this is when liquidity mining incentives were discovered. Liquidity mining incentives were discovered. And this basically means that if you're providing to the liquidity, if you're providing liquidity to a DEX, the DEX does know that you don't always have high volume and highly correlated assets. And so you're taking a high risk. If you're a liquidity provider, you take a certain risk for impermanent loss. And to mitigate the risk, to mitigate impermanent loss, liquidity mining incentives were invented. To mitigate impermanent loss, liquidity mining incentives were invented. And they invented it. And the liquidity mining incentives were basically, what is it? That means that if you provide, for example, USDC Bitcoin, so Bitcoin USDC, you are getting, if you provide Bitcoin USDC, you get some amount of tokens over the time you provide. So for example, on Mangata X, you would get MGX tokens. And those have a worth, and so you could sell them or you can keep them, and they are compensating you for impermanent loss. And that way, suddenly providing liquidity started to make sense. And when it started to make sense, people started to provide liquidity, and this led to a boom of decentralized exchanges suddenly using that mechanism, suddenly using liquidity mining, and suddenly you saw a lot of economic activity start going, and because people were just started to get a lot of money suddenly for providing liquidity. There was a lot of speculation happening, and this started the DeFi summer of 2020 when a lot of this activity started to happen. So impermanent loss is a risk, everyone should be aware of it, and you should always have it in your calculation. But it can be mitigated by liquidity mining. And this is what you need to look at. And I think on that note, we should end it, or at least I should end my monologue. Martina, what do you think?
Yeah, it took some time, my question regarding this impermanent loss, but it's great you also provided a solution how to mitigate it. That's great. I learned a lot tonight.
Okay. Yeah, thank you, Martina. Yeah, so it was a lot ad hoc the session today. it wasn't a finished session, but I think it made sense to make it more interactive, because then not everything is rounded, not everything is ready, but we can have a short discussion about it. And maybe, Martina, what I can tell you, so these are a lot of concepts. I guess we introduced maybe 10 terms today, or 15 different terms today. So I guess it's nice to have a rough overview, and then over time all the things will start falling into place, and you look at it from different perspectives, and then just everything starts to click over time. The rest is to be seen, I guess. And with that, I would like to close the session, and thank you for coming here today, Martina.
Thank you, Tommy. Thank you, everyone. It was really very useful. Thank you very much.
And have a good week, everyone else. Goodbye.